everybody. Welcome, welcome, welcome. Thank you for everyone that's here. Thank you for tuning in. My name is Kadu Williams, and this video today is about the new income-driven loan repayment, student loan repayment plan that was implemented by President Joe Biden. And so the plan is called SAVE, and it's short for Saving on a Valuable Education. So I'm gonna go over a few things about this plan. I'm gonna go over how does it work, how does it differ from previous income-driven repayment plans, how it will affect interest on loans, how does it affect debt forgiveness, as well as how much we will, how much, give you an example of how much you'll save, how much you'll pay and save, depending on your loan. Also, who is eligible and how you can apply. As also, I'll go over how soon can you start to make payments. All right. So a few things about this new income-driven repayment plan for student loans. Right. This will affect over 40 million Americans whose federal student loan payments are coming due this fall. And this fall meaning, I believe, October 1st, right? Which is about a month from now, right? It is an income-driven repayment plan, savings on a valuable education plan, commonly known as SAVE, right? Which ties monthly payments to earnings and family size. The White House estimates the plan could save the typical borrower up to $1,000 a year on payments because it reduces the amount of income used to calculate monthly bills. Please note that this is an amended version of an existing income-driven repayment plan, guys. And the existing plan is known as Revised Pay-As-You-Earn, or Repay. I'm sure a lot of people are probably familiar with this if you click this video and you had student loans. All right, so how does income-driven plans work? Let's talk about that, right? Income-driven plans cap monthly bills at a percentage of a borrower's earnings and extend repayment periods from the standard 10 years to as long as 25 years, with the promise of forgiving the balance at the end of that term. Payments are based on a percentage of discretionary income, typically whatever a person earns above 150% of the federal poverty line. Okay, so SAVE differs from the existing four income-driven repayment plans in a few ways, right? There was four of them before SAVE, right? And this is how they differ. This is how SAVE is different from them. It raises the amount of income shielded from the calculation of your payments from 150% to 225% of the federal property line. Now, what does that mean? I know that's like gibberish to a lot of people, and I think they could have explained that a little bit more, but let me explain. So this means that the calculation percentage of income, which is the adjusted gross income that you see on your tax return, it's basically the last number on your tax return. The adjusted gross income is, so this means the calculation percentage of income, right, from the AGI, adjusted gross income used, will be less than the previous income-driven repayment plans, because the income is represented by a lower number, guys. So basically, they take your adjusted gross income, and then they less whatever the number is, which is in this case 225% of the federal property line, which, let's say, I'm not sure what the number is, I don't want to put it out there, but let's say for your situation, because there's different situations where there's different amounts. Let's say for your situation, it's okay, so let's say the poverty line is $10,000 and you're making $50,000 per year. 225% of the poverty line is actually 22,500. Now, let me pull my calculator out here so I'm not doing the wrong thing. How they would calculate what your income is, they would first take the 50,000 per year that you're making, right? They would less it from the 22,500, which is 225% of $10,000, which is the poverty line. So that means your income would be 27,500, and that would be the percentage that they would times or factor against your to in order to figure out what your monthly and year and annual payment would be. So your income would technically be 27,500 when they're doing their calculation. The plan also caps payments for undergraduate loans to 5% for income above that 225% threshold instead of 10%. All right. Um, People with debt from undergraduate and graduate studies will pay a weighted average between 5% and 10%, right? Additionally, you can skip having to manually recertify your income under SAVE if you give approval for the department to automatically assess your latest tax return from the Internal Revenue Service. So, guys, if you don't want to go through that paperwork every single year, you can definitely have them automatically do that, which will save you a bunch of time. All right. So that's how the new Save plan differs from the previous four income driven repayment plans. Now, will Save affect the interest on your loans? Will it? Please note that under other income driven plans, if your monthly loan payment was not sufficient to cover the interest that had accrued on your debt, the unpaid portion would be added onto your remaining balance, but that would end under the savings plan. What does that mean? I'll go into it a little bit further. As long as you pay what you owe under this plan, you'll no longer see your loan balance grow because of unpaid interest, Biden said about the SAVE plan. So let me give you an example of what that means that I just, those two sentences that I just stated above. So, for example, if $50 in interest accumulates each month and you have a $30 payment per month, the remaining $20 would not be charged. So that means whatever your payment is when they calculate the percentage of the difference of your adjusted gross income and the federal poverty line, whatever the percentage is that they calculate your yearly payment or monthly payment as is, that payment is fixed. So what if your interest actually is above that, then it will basically be forgiven. That's what it's basically saying. This is the only income-driven repayment plan that prevents negative amortization. Negative amortization is one of the reasons borrowers can see their balances balloon over time. So, I mean, before I get into the other part of the article or this press release, guys, it looks like Biden is not gonna and his administration is not gonna, President Biden and his administration is not gonna forgive student loans as promised. It doesn't seem as if it's gonna work the way how he promised it. So this might be the next best alternative. How does the SAVE plan affect debt forgiveness? The loan forgiveness component of SAVE is most generous for people who didn't borrow much. If you borrowed $12,000 or less for undergraduate or graduate school, you will receive loan forgiveness after making 10 years worth of payments instead of 20 or 25 years worth. Every additional $1,000 borrowed above $12,000 would add 1 year of monthly payments to the time a borrower must pay before their debt is forgiven. So if you borrowed $14,000, it would take 12 years of payments before your balance is forgiven. Or a lot more than that, the plan still caps the number of years of forgiveness at 20 years for undergrad loans and 25 years for grad debt. So yes, every $1,000 is a year's worth. Over 12,000 is a year's more worth of payment, guys. But it caps out at 20 years for undergrad loans and 25 years for grad loans, and then the rest of it will be forgiven. Like I said, this appears to be the alternative to just totally forgiving student loans, because based on what I'm reading here, it sounds as if yes, there's gonna be some people that are going to end up paying off their loan by themselves based on how this plan is set up, because there's a lot of factors. The factors are how much money you make, that's a big factor. How much you owe, that's a big factor, and what your payment is basically. So a lot of people will end up paying off their loans by themselves, but then a lot of people will end up paying off a certain portion of their loans and then having the rest being forgiven by the government. All right. So how much will you pay on this SAVE plan, right? SAVE. Because because of the higher income exemption, a single borrower earning under 32,800 or a family of 4 earning under 67,500 would not have to make payments under the SAVE plan while still getting credit towards loan forgiveness. The Biden administration says people who earn more could save $1,000 a year compared with other income-driven repayment plans. Say you owe $25,000 in student loans and earn $38,000 a year. Under the old repay plan, your monthly payment would have been $134 a month. But with the SAVE, it would be $43 a month. That amounts to an annual savings of $1,000.92. All right, so let me stop right here, guys. Disclaimer: this doesn't mean that because your payment is lower that it's necessarily a good thing in most situations. I am not giving any financial advice. This is not financial advice. Let me make this clear. But I think every situation, with regard to people that have student loans, every situation is different. If you're trying to focus on paying off a loan without having a lot of interest charge or paying a lot of interest, my first thought would be to always pay the loan aggressively. So pay as much as you can on the loan, and you will pay off the loan faster, and then you will have less interest that you have paid on the loan. That is interest in cash flow. Now, in some people's situation, I can see where this makes sense for them, because if you have multiple loans, for different reasons, let's say you have student loans here, you have other types of loans, right, that are probably as high as your student loan. And let's say your student loan interest is, let's say, 6%, right? And then you have another loan that has an interest of, let's say, 20%, 25%, because some people have credit card loans that are sky high. My thought would be to pay off the loan with the higher interest rate quicker, and then pay the minimum amount on the loan with the low interest rate, because it allows me to pay that minimum amount. And that's if I don't have the cash flow to pay off all those loans aggressively. So I think there's no one right way how to do things. You got to look at your whole financial landscape. Each individual has to look at their own financial situation to decide whether it makes sense to pay off the student loan aggressively, or whether it makes sense to take on this savings plan that Biden SAVE plan that President Biden and his administration implemented. All right, so who's eligible? People with federal loans made directly by the government for their own education are eligible for this plan, as well as who consolidate their loans from the defunct Federal Family Education Loan Program. However, people with Parent Plus loans are shut out of the new plan. Parents who have taken on federal debt for their children's education can only enroll in what's known as income contingent repayment, which caps monthly bills at 20% of disposable income and forgives the remaining balance after 25 years. Okay, so how to apply? You can apply on the Education Department's website at studentaid.gov/IDR. That's studentaid.gov/IDR. People who are already enrolled in the Repay plan will be automatically switched to SAVE. The Education Department said it will take about 10 minutes to complete the application and roughly 4 weeks for student loan services to process it. How soon could your payments drop? the Save Plan takes full effect in 2024, but borrowers can enroll now and some components are currently being implemented. The president among them is raising the income exemption from 150 to 225% of the poverty line, which I mentioned earlier. The education department will also stop charging monthly interest not covered by your payment on Save, which I mentioned before. Married borrowers who file their taxes separately will no longer be required to include their spouse's income in their payment calculation for the plan. So that's a good thing. And everyone who opts into having their tax data pulled won't have to submit documents to recertify their income annually. Like I said before, you have that option. Borrowers with undergrad debt will have to wait until next year to see their payments cut in half from 10 to 5% of income above 225%, or the weighted average between 5% and 10% for those who also have graduate loans. All right, guys. So, I mean, in a nutshell, this new Save Plan, I can see where it will help a lot of people, because, guys, if you know anything about finance or personal finance, cash flow is very important. And in a world where, let's say, you have like multiple loans, and like I said, I'm not a financial advisor, but in a world where you have multiple loans and you have multiple bills that you're paying, cash flow to maintain cash flow is very important. So yes, you're not getting to pay off the loan aggressively as you would like to save money on interest, but then there's this other factor of this loan to where you can get that loan forgiven after a certain amount of time. And if you do the calculations, in a lot of situations, you're paying, with the Save Plan, right? You're paying a lower monthly payment. And when you look at the amount of money you pay until it gets forgiven, the amount of money that you paid, which is a fixed payment, is actually less than the money that you owed. So, yeah, it works out. It will work out for a lot of people. I can see this working out for a lot of people, but then there's other people that I can see them just it doesn't make that much of a change for them. In fact, maybe it makes them pay more interest because they're stretching out the loan for a longer term. So different strokes for different folks, depends on what's your preference, but I just wanted to bring this information to you, so if you didn't know, at least somebody's here to break it down, give you an examples, so you can make an informed decision. And again, guys, I'm not a financial advisor. I'm just reading the press release and just want to bring this information to you guys. So again, guys, my name is Kadu Williams, and thank you for tuning into this channel. I do a lot of videos on multiple things. I'm not stuck in a box of finance or anything like that. I do entertainment in general, and there's a lot of videos that I do on pop culture, sports culture, education, all that type of stuff. I do music as well. So go ahead and hit the subscribe button, hit the like button if you would like to hear more videos or see more videos like this. All right. So until next time.